valuable Indian company, not on per share basis, total value. Per share is MRF, which is about 82,000 rupees. One share is at 80,000. That doesn't mean that MRF is the most valuable company, because you have to multiply a number of shares into market price. That is called the market capitalization. How much value the market assigns to a particular company. So, the 11 lakh crores, which is 11 trillion, is nothing but for Reliance, the number of shares they have, and per share every day the price is getting quoted. And this market capitalization, so Mukesh Ambani's net worth, let's say market capitalization of Reliance, and take his stake. Alright? So you should know what is market capitalization. Now this is all about, let's say, share price and share valuation. Now let's move on to the next topic, which is called the cost of capital. What is this? The investors supply capital. You know what are the sources of financing, which you already studied. It can be bond, it can be preference shares, it can be equity share. The investors supply the money to the corporations. What they want in return? They want return in return. They expect return, in other words. They require return. Remember, in the previous unit we studied the required rate of return on a security, capital asset pricing model. That time I said this is nothing but investors' required rate of return. There are many mechanisms to calculate that. CAPM is only one of the mechanisms. Now, what did we studied here when it comes to the share valuation relating to, let's say, preference shares? What is the value? The value equals dividend divided by K. This we said cost of equity. Here we didn't use any CAPM model. We have the market price readily available. So I can rearrange this equation. When it comes to preference shares, the cost of capital, I can say this is dividend divided by P. This is required rate of return. This is cost of capital for the preference shares. So whether it is required rate of return, whether it is cost of capital, all means the same. Don't think that someone invests in equity share, there is no cost. No, there is opportunity cost of capital. Instead of putting money in this company, I could have invested somewhere else. This cost of capital is very, very important for a firm. If the company is making more return than the cost of capital, then only the company can increase the value of the firm. If company is generating a return which is inferior to the cost of capital, company is not creating any economic value. It will not generate a return for the shareholders. The term cost of capital is not used in connection with working capital. Working capital is what? Short-term finance. Current asset minus current liability is working capital. The cost of capital is related to long-term source of finance. Alright? Now, we have to learn the cost of capital for debt, cost of capital for preferred stock, cost of capital for common stock, and cost of capital for retained earnings. These are the source of long-term finance. This is the capital structure, the components of the capital structure. It's long-term debt, preferred equity, common equity including retained earnings. Now what is the cost of capital of debt? Remember, debt got a particular feature. The interest expense is tax deductible. So if KD is the cost of debt, then KD into 1 minus tax rate, tax percentage is the cost of capital for debt. This KD into 1 minus tax rate, let's say the interest rate into 1 minus tax rate, the effective rate. The effective rate, remember the effective rate can be different than coupon rate, it depends. Effective rate into 1 minus tax rate. So this is what I said. If KD is the effective rate, KD into 1 minus tax rate. Cost of debt is always post-tax. The component of preferred stock, we can rearrange this equation, right? In the previous class, this is debt. This is preferred stock. Let me just write here. The price of a preference share can be calculated by this formula. So what is the K? Your K equals dividend divided by price. Look here, what did we learn? This is what we learned in the previous class, right? Dividend per share divided by cost of capital is the value or market price. So what is cost of capital? Dividend divided by simply the price. D by P you can say. Put it in a formula better. Dividend is, D is the dividend, P is the price for both. dividend divided by price is called dividend yield. You invest in a share, let's say 100 rupees, you expect 8 rupee dividend. I can say, like an FD rate of return, my rate of return on dividend yield is how much? If you look at any share, there is a parameter called dividend yield. Dividend divided by the current market price. You can think that way. You can think from the other formula how you arrived at the price of a preference share. This is about existing capital, what you have right now. Then we have, let's say, common stock, that is also same. Dividend on common stock divided by market price. Then you have retained earnings. In theory, the retained earnings, the cost of capital is same like the common stock, because you can distribute or you can capitalize through stock dividend. But in practical purpose, normally the cost of retained earnings is lower than cost of common stock. If you want to invest new share, let's say, if you want to increase the number of share, let's say you have to go for the share issue to the public. There are flotation costs. You issue the share at 100, but you will be getting only 95 because there are issue costs. So that way, retained earnings is the cost of capital for retained earnings is cheaper than a typical share. So in theory, it is considered equal, but for practical purpose, the cost of retained earnings is normally lower. If we look at all the three components of capital, cost of debt is the cheaper because the rate is not a cost, there is a tax advantage. You are taking it post tax. The preferred stock is little bit riskier. The most riskier stock is what? Most riskier component is common stock. We have seen earlier when we studied in the previous unit, the equity shareholders or common shareholders are exposed to more risk. So definitely they require more return. Because of that, the cost of capital is very high, or equity financing is that way more expensive than debt from cost of capital perspective. Do one thing, you read this one paragraph B. average cost of capital called WACC. Now we are going to learn it. And it is applied in the, how it is applied in the capital structural decision. On the CMA exam, you will be expected to calculate the WACC and the marginal cost of capital and demonstrate that you understand how they will affect investment decision for a business. Weighted average cost of capital. We discussed weighted average, right? Portfolio beta is the weighted average of the individual betas. Portfolio return is the weighted average. Similarly, we have weighted average cost of capital. Every company will have a targeted capital structure. They may say, okay, out of our capital structure, 70% may be from common stock, 20% preferred stock, and 10% debt. Look at this is weight. Sometimes they may say debt to equity is this much. Debt to equity equals 2. So for every $1 of debt, every $1 of equity, you have 2 debt. Debt will be 2, your equity will be 1. You can calculate the weightage. Let's say 67% will be debt. Equity will be 33%. That is another way of looking at it. So the company will have a policy how the long-term financing will be arranged. So what is WACC? As the name suggests, it is weighted average cost of capital. You will have the weight, you have the individual components. You arrive at the weight. But remember one thing, very, very important thing, the weights are based on respective market value, not on book value. Sometimes they may give you the book value, they will say the debt is quoting at a discount. Every time you have to look for the market value. You take the market value of every component, then take the value and do it. And let me tell you, from my experience, I don't know whether that is the case here out of 14. We studied many things. Weighted average, many occasions we will come across this calculation. Still, people don't know what is weighted average. Remember, we discussed the AVL example. We discussed n number of calculations. But some people just do the calculation mechanically. Next time someone asks what is weighted average, how to take weighted average, they don't know. We cannot pass CMA, simple. So the student should have a good idea. What is weight? What is the component? How to take a weighted average? Let's look at an example. So in WACC calculation, the weight should be based on market values. The following is from a firm's most recent balance sheet. The component 11.